Hey everyone, I am Choas. The most profound event shaping the global economy this week must be the Federal Reserve's quarter-point rate cut. So today, we're talking about the Federal Reserve, the central bank of the United States. Its interest rate decisions are probably the most watched economic signals in the world. Every hike or cut isn't just about the U.S., it shakes global markets. So looking back, what were the Fed's most important rate moves? What triggered them? And what impact did they leave behind? Let's walk through a few of these turning points. 1. The Volcker shock of the early 1980s. In the 1970s, the U.S. faced a nightmare: stagflation. Prices were soaring, but the economy was stagnant and unemployment was high. Two oil crises sent energy costs through the roof, government spending was heavy, and by 1980, inflation hit 15%. Fed Chair Paul Volcker decided to go all in. He abandoned gradual adjustments and slammed interest rates from 11% all the way up to 20%. This became known as the Volcker shock. The short-term cost? Brutal. Housing froze, factories shut down, and unemployment spiked to 10.8% in 1982. But this bitter medicine worked. By 1983, inflation dropped to around 3%, and people's expectations of rising prices finally broke. That set the stage for nearly 2 decades of stability, the era economists now call the Great Moderation. 2. The 2008 financial crisis. In the 2000s, a massive housing bubble swelled, fueled by easy credit and subprime mortgage securities. When housing prices started falling in 2006, defaults piled up and the financial system began to crack. The collapse of Lehman Brothers in September 2008 triggered global panic. This time, Fed Chair Bernanke launched an unprecedented rescue. First, slash rates all the way down to zero. Then roll out quantitative easing, buying government bonds and mortgage-backed securities to flood the system with money. These moves stopped a total collapse and prevented a second Great Depression. But recovery was painfully slow. By 2009, unemployment still hit 10%. And years of zero rates and QE created new headaches: asset bubbles, widening inequality, and a tough road back to normal. The Fed didn't raise rates again until late 2015. 3. The COVID-19 pandemic in 2020. Then came 2020. The pandemic shut down economies worldwide. The U.S. froze overnight, markets crashed, unemployment exploded, and liquidity dried up. Chair Jerome Powell moved even faster than in 2008. In March, 2 emergency rate cuts brought interest rates back to zero. The Fed launched what markets dubbed QE Infinity, pledging to buy whatever amount of assets was needed. And it reopened emergency lending tools to keep money flowing to households and businesses. The result? Markets stabilized almost instantly. With massive government stimulus on top, the economy staged a sharp rebound. But this extreme easing planted the seeds for the inflation surge that erupted in 2021 and beyond. 4. The aggressive hikes of 2022 to today. By late 2021, inflation turned from transitory to stubborn. Demand surged, supply chains broke down, and Russia's invasion of Ukraine pushed energy and food prices even higher. By June 2022, inflation peaked at 9.1%, the highest in 40 years. The Fed had no choice but to pivot hard. It launched the fastest rate hikes since the 1980s, raising rates from near zero to above 5% in just over a year. At the same time, it began quantitative tightening, shrinking its balance sheet and pulling money out of the system. These steps cooled inflation, but pressure is building. Housing has slowed, manufacturing is weakening, and recession fears linger. Powell's toughest challenge now? Engineering a soft landing, crushing inflation without wrecking jobs and growth. So, iron fist or soft hand? Looking back, the Fed has always been caught between 2 tough choices. Volcker's iron fist hikes restored stability, but at the cost of recession. Bernanke and Powell's massive easing kept the system alive, but risked bubbles and future inflation. Every decision is a trade-off: stabilize prices or protect jobs, flood markets with liquidity or prevent excess. The story of the Fed is really the story of trying to maintain stability in a world of uncertainty, a dynamic epic where each chapter shapes businesses, livelihoods, and the global economy.